Questions on corporation tax groups are not generally a favourite of students, so I have pulled together a video looking at the main bits of knowledge you need to have to help you tackle questions on this area. A good starting point is to consider what are we trying to achieve with these groups, and it's all about saving tax. Group companies have a close relationship with each other, so if one company in the group saves tax, then that actually is a good thing for others in the group because they've got some sort of shareholding in it and will benefit from more profits being available to be distributed as dividends. Let's start with a detailed look at what a 75% group relief group actually is. How are we going to spot a 75% group relief group? Two companies are members of a 75% group relief group where we've got one company that is a 75% subsidiary at least of the other, or both companies are at least 75% subsidiaries of a third. Indeed, we can have many more companies in a group than this, but it can help just to keep things simple to begin with. So a company, which we'd call the parent company, has got a 75% subsidiary if it owns, directly or indirectly, at least 75% of its ordinary share capital, and it's got the right to 75% or more of its distributable profits, and it's got the right to 75% of more of its net assets on a winding up. More commonly, you're just going to be looking at the percentage holding of ordinary share capital. For sub-subsidiaries to be in a group, the parent company must have an effective interest in that sub-subsidiary of at least 75%. So if X Limited owns 80% of Y Limited, say, and Y Limited in turn has 75% of Z Limited, then this means that X Limited and Y Limited are in a group relief group together because there's at least a 75% relationship between them. But Z Limited is not going to be in the group with them because X Limited only owns 60% of the shares indirectly in Z Limited. So how do we find that out? We multiply the 80% by 75% and that's how we get the 60%. But Z Limited could be in a separate group relief group with Y Limited because they have at least a 75% relationship between those two companies. So make sure you're looking out for direct and indirect holdings to include as many companies as you can in the group. You want to make the group as large as you can so that it gives you more options for how to use losses efficiently and to save tax overall as a group. And remember that the percentage holding in a company is only relevant for working out whether companies are in a group relief group. It's not relevant in determining the actual amount of group relief available. So if you've got an 80% holding in another company, you're in the same group relief group, but you can absolutely give away 100% of your loss if you wish. Are there any other restrictions on who can be a member of a group relief group? We do count foreign companies, but they can't actually take part in the sharing of losses for the purposes of the exam. Why would we count them in then? Well, it's because that foreign company might have a UK subsidiary that we could then get access to via an indirect holding. Now, when you're practicing these kind of questions to begin with, it can be helpful to draw out the group structure on paper and use different coloured pens to draw circles around different groups that you spot. But of course, in the exam, you're not going to be able to do this, so I wouldn't rely on this approach once you move into your revision phase. But you can use the scratch pad in the exam to list out the companies and their respective shareholdings. You need to make sure that you put the control running down the page, so put the overall parent company at the very top and then their subsidiaries below and then any of their own subsidiaries below that. And watch out for the different terms that we use for different members in the group. The company that's giving away a loss is called the surrendering company, and the company receiving the loss is called the claimant company. The losses that we can surrender under group relief are trading losses for the current period, brought forward trading losses to the extent they can't be used against the surrendering company's own total profits, unrelieved QCDs of the current period, unrelieved property business losses for the current period or brought forward. Now, by excess or unrelieved, we mean amounts that can't be set off against other income in that period. Of this list here, we will mainly focus on trading losses because they're the most common to see, but do watch out for these other expenses and losses. You'll notice that capital losses are not mentioned on this list, and that's because there's another way that capital losses can be shared, and we'll look at chargeable gains groups later on in this session. The maximum group relief that can be claimed is going to be the lower of surrendering company's loss. If it's a brought forward loss, then only as much as can't be used against their own current period profits, and the claimant company's taxable total profits for the same period after the deduction of total current period and brought forward losses. And notice that this is the maximum that can be group relieved. You can actually choose to transfer less if you wish, which might be useful if, say, there are a few companies that you want to share the loss with, or perhaps the company wants to carry some of the loss back against its own profits as well as using group relief. Now, what impact is there once we've decided how much group relief is available? Where we've got a group of companies that form a group relief group, losses of one group company can be surrendered to other companies in the group, and the recipient company can then relieve the losses against its own taxable total profits. So the group relief is deducted after QCDs in the corporation tax computation. A couple of complications to watch out for with group relief are where the companies in the group don't have the same year end, or where they've not been in the same group relief group for the whole time period of the loss. In either case, you're going to need to time apportion the profits and losses to arrive at the common time period and therefore the amount that can be shared. Now we're going to look at 75% chargeable gains groups. To spot a 75% chargeable gains group, we're going to look for one company that owns at least 75% of another company and that subsidiary perhaps has at least 75% in another company, and so on down a chain. But the parent company needs to also have indirectly more than 50% of the holding in any sub-subsidiary. So this is similar but slightly different to our group relief groups, where they had to have a 75% relationship from the top company to the bottom company directly or indirectly. Here for a gains group, we need 75% each direct part of the chain and more than 50% indirect relationship indirectly. Let's look at an example. We've got L Limited, which is the parent company here, as it's the one at the top of the structure. It's the one with the holdings in subsidiaries. To see which companies would be in the same chargeable gains group with L Limited, we're looking for two criteria to be met. We need to have at least a 75% relationship at each level of the chain. And we also need to have more than 50% relationship between the company at the top, L Limited, and any company lower down. So here we can see on the left-hand side of this diagram that between L and M and between M and O, we've got the at least 75% relationships we're looking for. But if we want to include O, we need to check that L has got more than 50% holding in O. How do we check that? We multiply 80% by 75%. Now this comes out at 60%. As this is more than 50% holding, we can include O in the same chargeable gains group as L and M. But can we make our chargeable gains group bigger? Can we include N and P? L and N have got at least a 75% relationship with each other, but do you see that P and N don't have a 75% relationship with each other? So regardless of the fact that L has got more than 50% of the shares in P indirectly via N, because we don't have that 75% relationship between N and P, P Limited can't be in the chargeable gains group. So in this example then, we've got P Limited being the only company that is not in the chargeable gains group. Now, are there any restrictions other than what we've seen so far on who can be a member of the group? We do count foreign companies in, but they can't actually take part in the benefits of being in the group. But different to our group relief rules for a chargeable gains group, a company cannot be in more than one chargeable gains group. So what impact is there once we've determined which companies are in the group together? Well, gains and losses that will arise from assets can be transferred between companies in the group in order to more efficiently use capital losses. Rollover relief is available where the replacement asset is acquired by another group member. So if Company A disposes of a qualifying asset and within the 4-year window Company B acquired a qualifying asset, then the gain from the disposal by Company A can actually be rolled over to Company B. And when an asset is transferred between one group company and another, we don't need to work out whether a gain or loss has been made, as the transfer is treated as made at no gain, no loss. They don't need to physically transfer the assets to the other company. The companies can elect for the transfer of ownership just on paper without the assets physically moving. The last group setup we're going to look at is a consortium, and if you are studying TX, then you don't need to worry about this one yet. It's only examinable in the ATX syllabus. A consortium is where we've got 2 or more companies that we call consortium members that between them own at least 75% of another company that we call the consortium company. Each of the consortium members needs to own at least 5%, but not more than 75% of the consortium company. We do include non-UK companies when we're trying to work out if we've got a consortium, because even though for your exam they can't take part in giving away or receiving a loss, including them could mean the difference between there being a consortium and there not being one. Now here in this example, we've got 4 companies that together own the whole of L Limited. All the companies that have got Ltd or PLC after them are assumed to be UK companies, but the one with Inc after its name, P Inc, is not a UK company. L Limited is what we would call the consortium company here, and the others are all consortium members apart from O, because O Limited does not hold at least 5% of the shares in L Limited. Although it can't actually take part in giving or receiving losses in this group, if we didn't include P Inc, then there wouldn't be a consortium in place, because together the other companies only would own 65% of the shares in L Limited. The same types of losses are available for consortium relief as we saw for group relief earlier, and we also have the same rules that apply to do with how much the claimant company can take with regards to companies with different accounting period end dates. But we do have quite a difference when we're looking at the amount of losses that can be surrendered, because we have to take account of the percentage shareholding relationship between the consortium company and the consortium member, and we don't have to do that when we're looking at group relief or chargeable gains groups. The maximum amount of consortium relief that can be surrendered is the lower of the result of the consortium member and the percentage holding the consortium member that wants to take part in the relief has in the consortium company multiplied by the consortium company's result. So the consortium relief can only be shared up and down the lines that run between our companies in that diagram we saw before. So MPLC could share losses with L Limited but couldn't share with NPLC because consortium members cannot share losses with each other. They can only share losses directly with the consortium company. And the other restriction to watch out for is that when we're working out the amount of relief that a consortium company can give away to the consortium member, then that consortium company must use the loss itself first before giving the rest away. I hope you find this video useful. Please hit like and don't forget to subscribe. If you've only looked at one requirement so far, please do check out the videos for the other requirements. Let me know in the comments if you've got any questions on these areas.